Good morning, all. Thank you all for joining on this Saturday morning. So, today's topic is building a resilient portfolio in a volatile world, 2026 playbook. So, the main reason for doing webinar in this topic is uh, 2025 was a tough year. The markets reached an all-time high in 2024 in the later stage, and from 2025, there have been a downtrend till the half of the year and then another uptrend. Now the markets, the year-to-date returns are almost 10% in this range, but still most of our portfolios are sitting in a loss. Even though index is slightly on a higher level, most of our own portfolio returns are still not haven't broken the all-time high, like how Nifty has did, because most of the stocks are down by 10-15%, almost one third of the uh, BSE 500 stocks universe. So how will 2026 be? So 2026 might also be a challenging year because the valuations have started to come down, but still most of the stocks are in an overvalued position. So still markets may take some time to correct. So how to build a portfolio which can weather all conditions is what we'll try to learn in this from this webinar. So let's just quickly get started. So I just want to start by giving an example actually. So just like how you know um uh, to build a building, you would actually need a lot of components. So just like that, if you want to build a good proper portfolio, you need to have a lot of composition and a lot of other exposure in your portfolio. So it doesn't mean a portfolio only means investing in equity. You can also invest in other asset classes so that you can properly construct a portfolio which can weather all market conditions. Just like how a proper building, goodly constructed building weathers rains, thunders, storms, and everything. So, okay, what does volatility mean? Volatility generally means, uh, you know, there is an event happening, and based on that event, generally the market goes up or down very steeply. So, just to give you an example, right now there have been a lot of geopolitical tensions going on between India, US, India, Russia, sorry, US, Russia, and US China. And the main reason is wars and tariffs. And if you would have seen when US imposed tariffs in April, there was a big correction happening. And just like that, in 2022 there was war between Russia and Ukraine, and the markets corrected heavily across the globe. And whenever you have this Fed policy meeting, uh, the Fed actually decides to do the interest rate changes. There will be volatility. And to give you now another example, generally, when there are a lot of supply chain issues, like just like how the Suez Canal issue happened, the markets reacted. And recently this year, silver actually had a huge run, and there was actually a silver supply shortage. So even in the silver bullion market, there was not enough silver to meet the demand, so it actually went up more. Actually, the price of silver ETF spiked even more higher than the actual silver price value. So there are a lot of instances like this where the price might even go abnormally high or abnormally lower as well. So the only thing is we need to use the volatility to our favor. So to just give you one example was for our mutual fund clients, when silver went up abnormally high, we decided to cut some good profits. We decided to book profits, and we decided to cut the position in silver, not entirely, but we almost sold most of our positions. So, and let's say, for example, when COVID happened, when markets went abnormally lower than that, we deployed a lot of money when we were actually having cash and a lot more in debt. Just like that, to give you an example, maybe for next year, you can allocate some money towards debt or in cash. And if another event happens, you can use it to your favor, and you can use this debt amount back to equity, and you can buy it in cheaper valuations. So one lesson what we should do is we should always use volatility to our favor. So we'll just see what are the mistakes that generally most of our investors do. So to give you one example is there will be a lot of over concentration in one particular market cap or one particular sector. A lot of people think money can be made only in small cap at all times. So generally they take more risk, but actually you can make money, get returns by taking no risk at all. And that was what was happening in 2025. Everyone thought we should only invest in equity, but a lot of opportunity was there in gold and silver, where there are no, when generally most people think, because gold and silver are a hedge and they generally don't yield returns, but actually the opposite happened. Gold, silver actually gave more than 40-50%. Uh, in absolute terms, it's almost more than higher, but it gave more returns than equity actually. So you can't take exposure into a particular segment or a particular themes. To give you an example, in 2008, when there was an infra boom, everyone having a lot of infrastructure stocks. Even most of the mutual fund had a lot of infrastructure exposure. But after that, there was a big infra market crash. A lot of these infrastructure companies went bankrupt, and it took a lot more years for the infra index to give returns. And another example is investing in the IT index. Most people think there are a lot of challenges faced by the IT market right now. One such thing is AI, and people think even though AI is the future, people blindly invest in IT index. But most of the IT index carries most of the services industry IT stocks, which doesn't have much growth compared to the IT AI stocks. So you need to diversify your portfolio across market caps and across asset classes. And generally, nobody can time the market. So it's always better to average your positions, and you need to think long term. And chasing past performance is generally not a sign of guaranteed returns for the future. Uh, in the past, uh, some of the mutual fund stocks or an asset class wouldn't have yielded returns in a lot of years, and suddenly they'll do better. And the stocks which have done better won't give future returns. And ignoring asset allocation is generally a very big blunder most of the investors do. You can actually make consistent return if you do a proper allocation, asset allocation. Because if you've had a 100% equity portfolio, most of the investors wouldn't have made any money in the last 1 year. They would have neither lost, most of them would stay flat or be down by 10-15%. But in case if they've had exposure to gold, silver, they would have easily by 15-20% minimum. So what is a resilient portfolio? A resilient portfolio is just like what I said, is a very strong building. Just like how a strong building is built, we should build a very strong portfolio, and which should weather all market conditions, and which survives all market crashes, and which should recover faster, and it should also deliver consistent returns. Because uh, if you do a proper asset allocation, you would actually, in every year, one asset class would be the highest performer, and in each year, if you take a proper position to that to that particular asset class, you would actually make decent consistent returns. And this thing, by following all these rules, you'll be able to have a very beautiful peace of mind. You can actually sleep. So now we'll just look at what playbook we did for 2025 for our investors. So you would have seen, I'll just give you an example from Jan 1 to December, as of today, Nifty is up by 10%, mid cap is up by 2%, and small cap is down by 8%. Because uh, most of the mid and small cap stocks were already at an overvalued position from the last bull run, and now only mid and small caps have started to correct, whereas large cap valuations were somewhat fair, and their earnings growth was much more stable, and there was some visibility happening in large cap side. So we decided to invest only in large caps for our clients, along with gold and silver, and the World Gold Fund, which is a gold mining fund, which is an international fund, along with the gilt funds and corporate bond funds. So this was our playbook, and we also had good concentration to thematic investments in banking and consumption, which we still hold. So one thing I would just want to bring to your notice is the last 5 years we had an absolute run. The market gave abnormal returns, which is not a regular occurrence in the equity market, which is not a regular occurrence in the stock market. So we can't expect our future investments, our future returns to be just like what was happening in 2020 to 2025. So we should actually manage our expectations. We should revise our expectation. We should temper our return expectations. So even the biggest fund managers in the industry are telling this actually, and we as an investor should be mindful of this. And so we can't, we shouldn't actually take a lot more risk and build an aggressive portfolio, because when the markets have been giving huge returns, like there might be a phase where there might be a prolonged bear market or a very sideways market. So rather than thinking how we can uh, pick a multi-bagger stock, we should focus on how to choose a stock which has a very low downside risk, which so we should protect the downside from the stock going down, and we shouldn't chase returns, and rather than thinking in a short term basis, like we should actually try to invest for a very long period of time. And rather than following a pure equity portfolio, we should diversify and make a multi asset portfolio. So 2026, what you should focus is you should actually choose quality over hype. You shouldn't just focus on what the markets and what the retail investors, most of them, are chasing. If you see, most of the investors are still investing in IPOs, most of them are still investing in small caps, most of them are investing based on the past performance. You should actually see in terms of, let's say for example, if you want to build a stock portfolio, an equity portfolio, rather than chasing the hot stocks, you should actually focus more on the fundamentals. You should see, irrespective of large, mid, or small, you should actually focus on the company's balance sheet, their cash flows, their management, whether they've uh, you know uh, you should just see whether they've done what they've said in the previous quarters, and you should see whether they have you should try to invest in stocks which have no or low debt. This the qualities which I've mentioned here, right? This is what we focus on the solitaire PMS portfolio. The investment philosophies are this actually, which even though it's a multi-cap PMS, and which has most of the exposure to mid and small caps, the stocks inside the portfolio have a much more higher quality based on these the points I've mentioned here. So this is how you should actually pick stocks which will survive even if they face a bad year, because then it won't be a question of whether if it will give returns. It will be a question of when it will perform. Maybe next year it won't perform, but still, if you choose on quality, it will perform over a long period of time. You just need to wait. They won't go bankrupt. So that's the main reason, because companies with no or low debt can't go bankrupt. So now let's just take a look at how to build a resilient portfolio for the next year. So as I said, still you can hold on to large caps. because large cap seems very comfortable and safe and stable. Maybe if you want to invest in mid and small caps, you can follow the rules that I mentioned in the previous slide. And another main component is debt, which is just like acts as a shock absorber, just like a suspension and a bumper to our vehicle. So it's purely for downside protection. Yes, you may even notice we even bought debt in the last 9 months, and debt hasn't performed at all. But still, because the FAs are actually selling, there is an actual sell off happening in the debt market. But generally, this is a very new thing, because generally when rate cuts are done, the bond price goes up, right? So that was the reason. But still, uh, the bond market are yet to give returns in the last 1 year. But still, uh, the valuations are very high in equity market, so we just want to protect the downside protection. Yeah. And precious metals, if you have bought it in the last couple of years, you can hold on to maybe 10% of your overall portfolio weightage. But it doesn't mean that you should mandatorily buy it even at this price. You don't If you don't have precious metals, you don't need to buy it. And global equity, compared to India, the valuations in US, China, maybe apart from the top seven, max seven, the mid and small caps in US are actually fair. And then same goes to China. There are a lot of things happening in China. So you can actually focus on the international part as well. But the limitation, the portfolio weightage can be 5 to 10%. So this is the actual strategy we are trying to build for our mutual fund clients for the next year. So what to be careful in 2026. So generally, we try to avoid IPOs at all times, and still, almost retail investors are the only ones who are actually still participating in IPO. Most of the retail money is going to IPO still, and easily the promoters, the institutions who invested in the seed rounds are easily able to liquidate their positions through IPOs. And IPOs are listed at very crazy higher valuations. And this is one of the mistakes you can actually be avoid. So you can stay away from IPOs, and you can't have excessive small cap exposure, because small caps have just started to correct. There's a even more higher chance for this trend to continue. So maybe definitely we'll try to invest in this space in the near future, but definitely not yet. Small and mid caps are not out of the woods completely. And definitely, like, investing in companies with high debt are always carry huge risk, because they have a higher chance of going bankrupt. And avoid a single thematic investments. Generally, if you can invest in thematic investments with higher conviction, but you need to diversify it properly. You can't invest 100% of your portfolio in a single thing. And you should avoid trading, and you should definitely avoid over trading. And you can't blindly follow influencers, and you can't blindly invest in whatever stocks they're saying. That time is actually over. SEBI is actually hunting to actually to bring down these influencer following who are giving stock recommendations. So one of the best strategies to follow in terms of portfolio deployment is to do SIP, STPs in this current market scenario, because uh, generally that's a saying by Warren Buffett that time in the market beats timing the market. That is, the number of years you spend will actually outperform if than the number of times you try to time the market. So SIP is one such investment approach where you can invest on a monthly basis, which actually develops a good savings habit, and which actually averages your price, your buying price. So SIP is one a good strategy to follow. And if you want to do a lump sum, generally it's okay to do an STP, which is a systematic transfer plan, where you invest in a liquid fund, and from that liquid fund the amount will get split equally into the number of weeks you want to deploy, and every week an equal amount goes from this liquid fund to equity fund. So if you do like this, volatility will actually work out to your favor. So as I mentioned in the beginning, volatility means opportunity. Doesn't mean volatility should actually scare you, but if you're always ready and prepared, you know what to do in what situations, you can actually be prepared to face volatility and use it to your opportunity. So what you need to do is you should always have some dry powder cash to make use of those opportunities, and you should always be diversified so that maybe one part of the portfolio might get hit, but the other part, the parts of the portfolio will actually perform, which will give you returns on that year, which will, in that situation you can always actually survive. So generally in stock market, it doesn't mean you need to become a crorepati or $1 million investor in a very short span of time. You always need to survive challenging years. You just need to survive. That's the only thing to travel. You need to stay invested. You need to be in the game to make returns. So that's the main thing. So if you take aggressive risks, and you'll actually easily blow out your portfolio. And then, like, most of the investors exit after such instances. So we need to be prepared, and we need to face volatility, and we need to survive. So that's what matters the most. The returns are next. So if you properly do this, I think we can definitely do a good job. Thank you all. Thanks for attending. I hope you found the session useful. Uh, yeah. Have a nice weekend. Thank you.